So we are here today for our first Q&A webinar. I'm going to give people maybe a minute or so to hop in. I see some people are still kind of joining, so let's give it a minute. Now, I know you guys are on the East Coast, so maybe Florida, New York, where are you guys at today?
Florida for me.
Florida? Very cool.
Yeah, New York for myself.
Okay, awesome.
Always a new place. New week, new
Yeah.
place.
Very cool. All right, so giving people a few minutes to hop in and then we will get right into it. All right, so good afternoon, everybody, and welcome to today's Q&R webinar with Still Property Group. I'm Jeanette Cornish from Digital Niche Agency, and I'll be your host for this session. So we're happy to have the leadership team here from Still Property Group. I have Jack, David, and Armand, and they'll be sharing their expertise and answering questions about adaptive reuse in the real estate sector. For those of you who still may be new to Still Property Group, lots of years of experience specializing in real estate development, over 30 years, over $1 billion in completed conversion projects. Their focus is on residential adaptive reuse projects, particularly transforming distressed office and hotel assets. And during today's session, we're going to explore their approach to identifying conversion opportunities, how they're going to transform distressed properties into successful residential developments. And then also we're going to be talking about the current Reg D investment opportunity that also gives investors a chance to come alongside them. So we have collected some questions in advance, but please feel free to submit questions throughout. We will have a Q&A portion at the end to discuss. So yeah, without further ado, Jack, I'll let you take it away, the CEO of Still Property Group.
Thank you so much, Jeanette. Welcome, everyone. Thank you for joining us. Just a little background on myself and our leadership team. It is myself and my two sons, along with some others who contribute quite a bit of talent to our team. I'm a Wharton graduate and have experience, a trained attorney. I don't practice except in areas of our business. David is also an attorney. He's my son, older son. But he's also been involved in our company for almost 14 years now. And Armand is a graduate of NYU Stern School and has been in active in real estate environment for almost 12 years now as well. And we are complemented by those who have practiced in the area of raising funds, as well as property construction management experience and development experience. So strong, solid team of leaders who then adapt to the individual projects, and local area support is retained and used to complete our projects and identify and complete our projects as well. So I'm going to spend a few minutes with you to explain why adaptive reuse is something you need to look at, why our group is particularly positioned well to take advantage of the opportunities, and then why this particular fund is a fund that is unique and deserves your review and your potential involvement. So, as I said, we're going to kind of start with why invest in the property group itself and Still Property Group, and then why the adaptive reuse and why the fund itself. So in terms of why Still PG, we are a company or group of companies that have a consolidated history of converting 5,000 units, approximately $500 million worth of equity value created. As Jeanette said, about $1 billion worth of activity. We are recognized as the #1 specialists nationwide in a particular area of conversion, which is the cooperative to condominium conversions. And we've done as many as 55 projects across that time period and across the country itself. Our group started as the Hutton Group. We've emerged as SPG now, Still Property Group, as a consolidated group of all of our experiences put together. The we've had decades of experience, as I mentioned, and some of those include a property we just completed about 3 years ago, or 4 years ago, actually, at 3 Island Avenue in Miami Beach. It was a co-op to condo conversion, valued at around 40 million before conversion and about 54 million after. We completed that in less than a year. We've done the same with Park Hudson, that had a collapsed garage that we were able to provide funding for and then rebuild, and we were involved in that. That went from almost 20 million to about 56 million, a 193% increase in value, which is a little higher than normal, but not extraordinary. We did one in Hawaii as well more recently, and that was a 56 unit, increased almost 50% from co-op to condo, and then also in Laguna Beach, where we actually helped to purchase the property that was on a leased land, and that also experienced almost an 87% increase in value. So this is just some experience levels in the last couple of decades. We also have a particularly well-developed competitive edge in these adaptive reuse areas. They include sourcing and procurement, where we actually are sourcing our own materials now, saving approximately 10 to 20% on the budget. Kind of really helps the bottom line, but also helps with assuring quality and consistency in getting the products over, and it really shortens or eliminates to some degree the delays that material shortages, which we've experienced recently, have created. So that's one particular reason why we have been able to secure projects that others have passed by, because the economics haven't penciled out for them. It does pencil for us because we do our own procurement and sourcing. The other thing that's really critical is we focus on a loyal staff that we can now distribute in other projects along the market area geographically, but also doing a lot of this in a self-performing manner rather than relying on third parties, which also, again, reduces costs and keeps things in our control and streamlines operations and maximum efficiency. I can't tell you how many times I've heard our contemporaries say that, we've experienced delays, we experienced excess costs, and primarily because their subcontractors didn't show up or they had to replace them with more expensive options. This is something we've been able to avoid or minimize, and that has helped our bottom line. We've also are selective in our markets. We leverage the networks locally that we develop, and we also work with off-market projects and sourcing those projects, which helps us obtain projects that others wouldn't even have available to them. So why the adaptive reuse space? Well, this is now a trend that has become almost mainstream, but the interesting point is there's a lot of talk about adaptive reuse, but not a lot of actual projects going online. And there's a couple of reasons why. We'll talk about those in a few minutes. But again, more specifically, office to residential conversions essentially address several things. Of course, they both address, both office and hotel, of course, they both address residential shortages, but how? Well, the office market is transforming, essentially taking the office products that are distressed, transforming them into the residential product. And in our case, we create highly desirable, well-amenitized residential projects. There are others who don't do much amenities. They just simply do the minimal and they convert it into residential. That's fine, but our program is a little different, and therefore we get a higher price either on the rental or on the sale. And one of the advantages to residential to office to residential is that it does have a lower cost component than doing ground up infill projects. So that's one of the reasons why office to residential has really emerged amongst a number of markets. The hotel to residential is less dominant, but as interesting. It repurposes these underutilized hotels, which may not have gone through significant development or refreshing, so to speak. And we create unique space-efficient rental units and high-value alternatives to these traditional apartments and new developments. Interestingly enough, it does tend to be a little smaller in size, but with higher amenities present, it does have a strong market acceptance. And we've demonstrated that, and we'll show you a couple of examples of that in a moment. So again, some of the key elements to conversions are that it does have a lower cost basis than building new. It gets the projects completed faster because some of the existing structures are not going to have to be rebuilt as a new construction. And therefore it meets unmet demand right away, but also it meets unmet demand in urban markets or highly densely populated markets that are not so far apart, but need more housing than, let's say, more remote suburban markets. And it actually provides, if you're creative enough, interesting design elements that are also ending up being very desirable from a demand standpoint. Some of the other reasons why the opportunity exists for adaptive reuse is that the returns, like I said, are very good, very strong. But specifically, the housing shortages are in areas where some of these office and hotels already are experiencing distress. The other thing that has emerged as a reason for adaptive reuse to gain some momentum is the inflation that has existed in materials and with labor. And because you have existing product that can be adapted, those end costs are going to be a little bit lower than if you're building new. But if you don't manage it right, that could also not be so much of an advantage. But we have found a good way to get that accomplished, and our costs generally reach a better yield to cost returns. The other interesting element here, and it can be in favor or against this, is that municipalities who see their distressed existing assets in town floundering have actually passed adaptive reuse ordinances or made it easier to do adaptive reuse by those who know what they're doing. And that has actually created an opportunity that would otherwise not exist because you would have to do a demo on the whole property and then it costs you more. But so actually cities and towns that are seeing a large amount of distressed properties are assisting in this emergence of adaptive reuse. And there, of course, is the declining demand for office and hotel space, mostly office, of course, post-pandemic. So a couple of things to note that in terms of housing shortages, 3.8 million homes are calculated to be in need and therefore not existing, but in demand right now. That's nationwide, of course. And then the urban areas are actually experiencing a higher shortage effect than suburban and remote rural areas. As I mentioned, inflation pressures have also made adaptive reuse a really strong alternative to new build. 35% increase in material and labor costs, material costs alone have contributed to that. And adaptive reuses, as I mentioned, do take a little bit shorter of a time to build. The average build is about 18 to 24 months for adaptive reuse. New builds are somewhere closer to 30 months. So you can imagine almost half the time to take to get to market. And adaptive reuse projects often overall cost about 12 to 15% less than new builds. On the new regulation front, as I mentioned, there are new programs that the cities are actually encouraging the adaptive reuse, and we're taking advantage of those elements. And on the commercial distress side, because it's so distressed, we're actually able to buy these properties at below replacement value. So, for example, in Los Angeles, a new build for a new residential or new commercial building, even as an office building, could cost $400 to $500 a square foot, and that's just in terms of entire actual improvements, meaning structure. Doesn't even include the land. In our current one of our current projects that we're under contract and will be part of this fund, we're acquiring the properties at less than $100 a square foot, 1/5 of the replacement cost, and that includes land. So you can see what the advantages are in terms of buying right and being able to adaptively reuse the item. By the way, that has allowed us to have a cost basis on that project at approximately $650 all in, whereas the normal new projects are probably closer to $1,000 in that same market. So why invest in this fund? Well, several good reasons why. First, you're getting our team, the Still Property Group team, to actually execute on our plan with all the all the positive experience we have, the expertise we've developed. That can't be underestimated. The fund itself will be managed by our team. The initial fund amount will be presented as a $50 million fund, but we will close with less than that. We've in the general approach that we've made in terms of our presentation has been a $20 million fund, which will allow us to invest in many, many different projects. We can go into that in a moment. The target returns are, and these are with conservative estimates, is a 30% internal rate of return net to the fund investors. And that translates into a multiple of on invested capital of 2.3x. The average hold period is 4 years. Part of the reason is that it's a shorter time to do the adaptive reuse than new builds. And so that is, and these, upon the actual completion of the project and exit, the fund investors will receive their capital back, and at least that's generated from those cash flows, plus the profits. The most significant part of this is that we're sharing in the promote that we as developers generally enjoy outside of the joint venture partners that invest. So in our case, this fund is enjoying a 25% return on a 25% of our promote, in addition to a 15% net rate of return to investors before any distributions on the promoter made. So the waterfall is going to generate a fixed return, even if it requires us to cover that with other projects. So a project itself will generate a 15% return, even if it's not internally successful to that level. But also, more importantly, and in most cases, there's plenty of additional funds remaining, which is the promote part, and that the investors through the fund enjoy a 25% of that net amount, which boosts up the return significantly from the 15% return on the net preferred to almost double that. In fact, double that to 30% on our projections. The fund will have included in a management fee of 2% on all deployed capital, and that's on an annual basis. So an example of how a deal would be structured. First of all, on the left side, you see that again we estimate a $20 million fund deployment across probably anywhere between 6 to 12 projects. three of which are already in contract. We'll go over that in a moment, and ready to be deployed. That should give us the purchasing power of up to $450 million in deals. Expected, I'm sorry, 6 to 8 investments. We assume a 65% debt financing on these projects, which is very common and very reasonably acceptable to most lenders. We plan to co-invest side by side with the fund so that it demonstrates that we have skin in the game. And numerous partners that are standing by as limited partners will be joining as joint venture partners. Typically, they put in 80 to 90% of a particular deal's equity requirements. So, for example, in a typical deal or deal that we're talking about with a $56 million total project, which is on the bottom here, the sponsor, we would put in approximately 300,000. The fund would invest approximately 2.5 million for a total general partner contribution of 2.8 million, which represents 5% of the total. And the limited partners would put in 30% of the deal, and the balance is covered by the debt. So this is the capital stack. Sometimes we think about it from the reverse way: 65 debt, 35% equity, of which 30% are limited partners. These limited partners basically are the ones that are promoted, so to speak. They're the ones that receive a different waterfall than our investors in this fund. They only receive 8% typically preferred return, and then they're promoted as those returns increase. The benefit for the investors in our fund is that you will share in those promotes. So here's an example of how that works. So let's say, again, let's say the debt, the unleveraged return on the deal returns a 16% rate of return. If our lenders are providing 65% of our funding requirements at 10%, the presumed rate for loans, that leverages us up to that where overall equity deal will provide a 25% return. So that's the beauty of leverage, right? You get a higher return on your equity investment. But because our limited partners have a different arrangement where they have a preferred return of 8% and then a profit share above that, their return will be 18%, certainly more than the lender. But that also leverages us up as general partners to a total return of much higher than that. And as with the arrangements we have with the fund, which hopefully you'll invest in, the return will be 15% preferred before any promotion is actually distributed. And then above that, the 25% of all promote or carried interest is another way it's called, is added to that. And therefore, that leverages up the fund return to 30%. So that's the beauty of leverage. And that's exactly why this fund is so different. In most funds, you're either investing as the limited partner, or you certainly, even if you're co-investing with the GP, you're not earning a 25%. You're certainly not earning a 15% preferred return in most cases, but you're also not earning a full 25% of the promote. And if you are, the two combined generally is not achieving a 30% conservative rate of return. So another reason to invest in this fund is that we have 3 deals already in our pipeline, secured with hard investments, where these projects have been extensively prepared to close and then basically hit the ground with a shovel-ready status or ready to issue permit, which is unusual to say the least, but also very, very good for a standpoint of minimizing risks and maximizing returns. So one of the projects I was mentioning is in Los Angeles. It's in Hancock Park, which is right in between areas of Koreatown and Beverly Hills, closer to Beverly Hills. It is a well-known area where the average price of homes is actually about $8 to $20 million. They're larger homes, of course. This is the only building left that is above 3 stories that could be essentially adaptively reused. This is the old Farmers Insurance Market headquarters. We're going to basically turn this into 69 beautiful townhouse style as well as flats and penthouse condominiums with about 160,000 square feet of residential structure. And that is planned to close sometime in May or June of this year. Pioneer Townhomes is a property in San Mateo, 2 blocks from another project that we just exited, which I'm going to go over in a moment. Also, it is a commercial building right now. It's going to be converted into 10 townhomes in the very close to the Palo Alto, Mountain View locations where a lot of tech is now accelerating because of AI. And many homeowners or wannabe homeowners basically have very few options. And these townhomes will provide a tremendous opportunity for people to live in this area and be able to afford a great home for their family. This is a $23 million projected exit. This will take about 2 years to build and probably another year to sell out. The Jade Merritt Island is a hotel structure that's currently within a few miles from SpaceX. And the project will be essentially similar to another project that we're just working on right now called the Jade in Winter Haven. And we expect to convert that property from essentially a 1972 exterior walkout facility to a 1, 2, and 3 bedroom units. And we just received last night 100% unanimous approval by the planning department for our project. That is expected to close in the summer of this year as well. The case study that I wanted to point out is this is the one that is within 2 blocks of this this project right here. The townhouses in the Pioneer Vista Townhomes in San Mateo. So this was a property, 38 units townhomes that we completed just this past January. Total sales was $45 million. Our project cost was $37 million. This was a reuse of an existing residential property into condominiums. We converted very quickly several units that paid off the loan very quickly. We sold out all of the units in 24 months. And during that time, we had significant increase in interest rates. We're able to adapt to those because we had such a low base and cost, and we're able to actually exit the property within the time period that we expected. The internal rate of return on this project was over 50%, 1.8 multiple overall, and again, done within 24 months. And again, this is only 2 blocks from the project that we're working on for the Pioneer Vista. The other project that I mentioned when I was mentioning the Merritt Island hotel to condo conversion, I'm sorry, hotel to residential conversion, is a project in Winter Haven, which is the city where Legoland is. This was a property, 330 room hotel that was built in 1972. We converted it into 238 Class A units, and the average square footage is a little bit small on the small side, but we've had a tremendous acceptance of this within the market. We're at 90% occupancy in less than 6 months. You can tell what we did in terms of beautifying the center courtyard as well as the amenities. These are full units with full kitchens, washer and dryers, and plenty of space outside, but also very comfortable inside. And this is what we envision doing at the Merritt Island property. Very similar, in fact, built in the same year, maybe even by the same group. It was both Holiday Inns originally, and we expect to be very successful in Merritt Island as well. So to recap, why do the investment? with SPG. Why invest here? Well, again, there's a focus on our team with residential conversions in those coastal markets that have a very imbalanced supply and demand situation, therefore restrictive and therefore needing the residential stock. History of implementing creative and cost-effective approaches is part of our success. That's resulted in lower cost basis and provided unique value to the end user, and reduced our risk, by the way. As I explained, where interest rates were climbing, when we were doing the San Mateo conversion, we were able to adjust to it and still exit with a 50% internal rate of return. Again, a significant experience over 30 years with $1 billion worth of conversion projects puts the SPG team in a very distinctive and unique position to take advantage of these undervalued properties, securing them through creative funding and navigating those complexities that are inherent, of course, in conversion process, but with great success. We are able to offer you essentially part of the general partners promote through this unique fund, while still giving you a 15% preferred return on your investment through the fund. And that boosts the projected values that we expect for to 30% internal rate of return and a 2.3x multiple, equity multiple across the 4-year average holding period. And with that, I will send it back to Jeanette to help us with any questions that the attendees might have, which I'm happy to address.
Awesome. Well, yeah, thank you for that presentation. Definitely learned a lot, got some more insights onto your current pipeline and projects. So we do have a few questions that came in. Let me just pull up the chat right here and let's see. All right. So the first one is, can you elaborate on your process for identifying undervalued properties with conversion potential? And with that, what specific indicators do you look for?
Sure. We tend to look for several things when we look at a property or consider it for adaptive reuse. Those would include, for example, what is the cost basis that we're coming in at? What are the exit values, whether it's rental or sale? And what are the adaptability elements, I should say, whether it's a cost issue, the timing it will take to get the completion done, and the zoning, frankly, is also a factor. So all of those elements have to be at least manageable, if not positive, to start, and then we will look at those properties in a more serious interest as we consider them for acquisition.
Okay, awesome. Let's see. The next one is asking what unique challenges are present in converting office spaces versus hotel properties to residential units?
Yeah, that's actually a good question. So in an office structure, you have to pay particular attention to the floor plate or the layout. Many offices were built, especially more within the last 30 to 40 years, with keeping perimeters minimized with a large bullpen in the center. And that doesn't really work so well for adaptive reuse for residential. You create these very long and narrow railroad type property units, and that's not attractive. So what you want to do is try to locate office buildings that are more rectangular, that you can do center loaded corridors, and provide with a more reasonable use of those spaces for residential purposes, with plenty of windows in living rooms and bedrooms. That's the primary challenge in a office building. Now, unlike an office building, a hotel has different challenges. While they are smaller units that need to be combined, and therefore sometimes those units are at those rooms are separated by hard surfaces like concrete walls, which need to be cut and supported or resupported. Um, but uh, you don't have as much depth. You have more adaptability from a standpoint of the number of windows you have relative to the number of rooms you want to create. So that's also helpful. The other challenge with hotels is if you have the type of hotels that we've been focusing on recently in Florida, which are these exterior hallways, they actually create both opportunities and challenges at the same time in terms of creating an aesthetic that renters would like to have. It's not impossible, it's just something creative. For example, we put in privacy fences that broke up the monotony of these exterior walkways with the jade at Winter Haven, which really was very well received by the tenants and and their guests as well. So it's an interesting differences in terms of challenges, but they're all achievable. They're all challenges that can be met as long as you're creative and you have a good team to execute.
All right, well, thank you for that. I know we talked about several different projects, so from the Jade to the Pioneer to the Hancock. But with your wealth of experience, could you walk us through one of your most successful conversion projects and then, any key factors that contributed to that?
Yeah, I think I would probably want to use the Jade at Winter Haven as an example of a successful conversion. This was a property that had been built in 1972, enjoyed tremendous success as a hotel back in the 70s and 80s. This was the place where everybody came to when Cypress Gardens was the only thing that was attraction, before Disney and Universal was here in Orlando. Eventually, that Cypress Gardens became Legoland. The property went through several ownership and went into essentially being a one-star hotel, and went through COVID with some disastrous results. We came in and closed on the property in November of 22 and began to do an adaptive reuse with 1 and 2 bedrooms, transformed the courtyard, created beautiful sitting areas, a 20-foot wide double screen video, and a spa that is one of the largest in the county. Beautiful gym, nice co-work space that any tenant can use free of charge. All of these became our focus amenities, and the individual units, as I mentioned, became full, were renovated and combined to be full kitchen, beautiful bathrooms, upscale, quartz materials on all the counters and the bath surrounds. Um, and, we had some challenges. We had a few challenges that were unexpected, but the results were interesting and expected, but very rewarding. That is that we had a 90% occupancy within a few months. We offered ourselves as an alternative to new construction at about $200 to $300 less for tenants to come in, and that's what attracted us to versus others. But we were able to do that because we had a lower basis of cost, because we did all our own procurements, like we mentioned, as an advantage to working within the Still Property Group orbit. And we were able to activate some additional areas that were not active as a hotel. The whole section was closed down. We added a third story to that area. This is a 7-acre property that is not far from downtown Winter Haven, which is walkable. And so it also has a large commercial presence. There's every store every retail you can think of, every food establishment you can think of nationally is here. And so this was ideal for the type of conversion that we're speaking of, where you identify a hotel or a commercial space that is distressed, underperforming, and you transform it into a beautiful, highly amenitized residential property that offers the tenant and or the purchaser, if this was a condo, uh, a particularly cost-effective or lower cost alternative with all the amenities and all the benefits that come from a project that we would be involved in.
Okay, yeah, that definitely makes sense. I know you mentioned COVID in there, and obviously COVID, there's like a pre-COVID and a post-COVID. So, life isn't as we know it after. So, how has kind of your approach evolved over time? Just, with the economy and different climates. You guys have been doing this for 3 decades. How has that approach evolved? Or is it kind of
Yes, yeah, it's a great question. So we started out being the experts in conversion from a perspective of converting the type of ownership rather than the use of ownership, right? So we converted co-ops to condos, we converted residential to condos, meaning rental. Um, and of course, included in that were some, work that had to be completed. Now, today, it's about converting use. And uh, I think the adaptive nature of existing structures is now the focus, not only for us, but many others. And the question now is, how do you execute on that? The COVID situation increased costs substantially. It displaced people. It shifted population to areas where housing is a lot more constrained, and there's a true shortage, i.e., the central part of Florida. And because of price inflation, the ability for developers to meet that demand has become difficult. Also, for about 2 to 3 years during the height of COVID, there was no new construction or very limited. Uh, and that also exasperated the shortage. The the advantages of adaptive reuse, properly executed, is to meet that demand more quickly than new construction with less uh, cost, hopefully, if you do it right, and with more participation by the governmental sector. So that has given us a refocus on putting all of the skill sets that we've developed over 30 years in conversions to actually converting these office spaces and these hotel properties that are underperforming, but are available at a fraction of the replacement cost to residential units.
all right, thank you. Let's see. The next question here is, and I want to say we kind of touched on it, but let's just reiterate it again. What is your typical timeline from acquisition of a property to completion, for that adaptive reuse?
Uh, well, of course, it varies, right? I mean, property to property, some are going to take longer, some are going to take shorter. But typically, we would be looking at a long due diligence period uh, and an extended contract period so that we can put everything into position so that when we closed, we would be ready to hit the ground running. Shovel ready, so to speak, is a term that's used in the industry. What that does is it reduces two things. One, the risk that you can't do what you want to do. And the second and more prevalent is it takes you a lot longer to get started because you haven't gotten the proper approvals, you haven't secured the proper bids, you don't have the manpower to place there. So the more planning you do, the more time you have pre-closing is going to make it a lot easier, a lot less risky, and a lot more cost effective. So the typical period, for example, I'll give you an example on the project in San Mateo, one of the three that we have under contract that we're going to close in a few, probably within a month. We've had it under contract since May of last year. So we've got a lot of work done already. We've already have our applications into the city. Uh, all the entitlement risk has been pretty much removed. We know what we can build. There's no zoning issues. Um, and therefore we will be able to hopefully execute and start building this, demolishing it right after closing, and then start working on build out, which will take about 16 months. And then we think the sale process will take another year to complete the full sale of all 10 units. So it's approximately, a 3 to 3.5 year project. So from start to finish, you could be, and we say start, right, you want to either define it as the start, meaning the closing date, to the date of exit, which should be somewhere around that 4 year period that we mentioned in the presentation. But it could be really as effectively a 5 year process because you're doing a lot of that legwork before closing. We take the risk as the sponsor, we secure it, we put the deposits down, we spend the hard money getting everything ready, getting the team together, getting the plans done, getting the submissions in. Those are all part of the de-risking of the project before the fund comes in and contributes, as well as our limited partners and the lenders. That all makes it easier and less risky to participate.
All right, that makes sense. And it kind of segues into the next question that is here, which is about zoning and any regulatory hurdles. So, how do you approach that? It sounds like it's something that you're doing in the contract phase, but how do you approach zoning and regulatory hurdles when converting, properties to residential use?
Um, I guess a lot depends on the particular position of the cities and the governmental entities that might be state as well as city or county. Um, I guess the best way to say it is you do as much negotiating as you can. There is some room for negotiations. You can uh, find ways to earn waivers and concessions from governmental entities. One example is that on the San Mateo property that we were just talking about, this was an existing structure, it is an existing office building where the setbacks are non-conforming as to current new build requirements. We negotiated that by agreeing to give one of those units at a lower cost to an affordable housing candidate, which the city identifies. And by giving that one unit out of 10, a 10% affordable housing component, we were able to earn those waivers and concessions that would otherwise not allow us to build what we want to build. The other was that we identified this area as one that was rezoned or overzoned with a residential overlay, even though it was all commercial. It is primarily commercial. This particular property had a recent zoning change, which then allowed us to identify it as an opportunity. So these are ways in which you can work with current governmental entities. Another one, by the way, is that the Hancock Park, which is the project that we talked about with 69 units in that used to be the Farmers Insurance headquarters, beautiful building, 8 stories, wonderful views all around. You can see the Hollywood Hills, the Hollywood sign in the hills. You can see all the way to the water where Santa Monica is. You can see downtown. You can see West Hollywood as well as Century City. just a beautiful, beautiful building. But this property was able to get entitled by the seller for something different than what we want to do, which was a partially commercial, partially residential. That's what they had arranged. We came in and restructured it to be all residential, made a lot more sense. And we're going to be using a recently approved adaptive reuse ordinance that the city of Los Angeles is very much in the position to completely approve. They approved it partially. It's now going through a particular process. But once again, the city recognizes that they have a lot of office buildings that are empty and they want to do something about it. And gosh, Los Angeles is probably the center point of all of the shortages of residential housing nationally that you read about and see. They are the poster child, if you will, and they recognize it. And to their credit, they adopted an adaptive reuse that makes it a lot easier to go through that process with a lot of it waivers and concessions that take into account the reality that these office buildings, have to be adapted to conform to residential property. Nothing is forsaken in terms of safety. Life safety issues are always top, right? Priority, whether it's sprinkler systems and exit areas and, safeguards. Those are always part of, what you have to do in the property. But other things that, for example, setbacks and parking issues and things like that are more adaptable and waivable, which these ordinances allow.
Awesome. I know in one slide in the beginning, there was something that you were saying, there's different special programs and things like that. Would you say LA, with many empty buildings and having that need for adaptive reuse, do they offer more special programs? Do you find that, or do you also see that in Florida market? Do you see that in the Hawaii market, or are those what kind of incentivize you guys looking for certain buildings?
It's a pardon the pun, but it's adapting. The city fathers are realizing that it's to their benefit to become more realistic about what needs to be stressed and what needs to be waived. Much of the current codes, irrespective of where you're talking about, but differing levels, are so antiquated that they don't help the uh, the ability to increase housing stock. Uh, and they, as city fathers and state legislators, they're recognizing that they have to be flexible. So it is a bit of a moving target, which benefits us and positions us uniquely in a place where we can come in, demonstrate that we've had tremendous success than others in doing these adaptive reuse, and we're willing to be good partners with those cities and the states to create safe, cost effective housing, which otherwise they're not going to have if they don't make those arrangements and be flexible. I have seen a city like Los Angeles, which has been notorious for being restrictive in new housing. Some projects take 10 to 12 years to get approved. Really change and pivot to a different approach. And to their credit, I find that to be the best example of how these cities are changing in the way they're approaching this. An example also in Florida is that we received a tax benefit for converting the hotel to two individual apartments by the city of Winter Haven, which others got it too, but we received more concessions, I think, because we were converting something that was what they thought might have been a blighted area, but we made it into something extraordinary. I mean, everybody is just in awe of what we've been able to do, and we become an example for others in the area about how their older assets and older hotels can be repositioned and repurposed.
Awesome. Well, yeah, thank you for that. We do have one more question, and hopefully that'll kind of tie everything up. I do want to remind everybody that we currently have a Reg D going on. You can find out more information by going to stillpg.com. I will drop that in the chat. You can always book a call with Jack and the team to ask more questions and learn more about the deals that are happening. So the last question that I have here is, what makes your current 3 deals in contract particularly attractive from an investment standpoint?
Yeah, we touched a little bit on it, but it's a good way to wrap it up. I agree. These 3 deals are unique in the sense that in most cases, at least that I have seen with funds being offered under Reg D, the sponsors are generally raising the money to then go out and find the products that fit their thesis. They can't identify specific properties. They don't have them under contract. Never mind being essentially in a where there's non-refundable deposits. So it's certain to be moving forward. I mean, we have probably over $1 million, $1.5 million already invested in these properties. And so we are ready to close. And that is very unique for any fund to have that ability to be able to say, we have assets that we've identified are in a position where funds can be deployed immediately. And more importantly, every one of these is near or at the point where they're shovel ready, which means that when we close the fund, those monies can be immediately deployed and begun to be used to advance this project, and therefore the internal rate of return is much higher. The risks of market risks, interest rate risks are reduced. And when we close these deals, generally our loans are all set up, they're fully funded. Generally, we don't need any additional equity or any additional capital calls because we basically fund the entire project. So for all these reasons, this is a fund that can immediately deploy on 3 specific projects that have been worked on for almost a year now, over a year, and can be where risks is reduced, income and project success is more assured. Not that it's always guaranteed, but also we have another 3 to 5 additional projects that we are already underwriting and in some cases in the due diligence, which we will also eventually allow for the fund to invest in the same manner, where there'd be a 15% preferred return, and projections are around 30%, if not more, in actual final internal rate of returns, and a 2.3 plus equity multiple, assuming all of our projections are correct. And we do generally underwrite conservatively, so we like to under promise and overperform, and that's been part of our success for all these years.